Hello, everyone, and thank you so much for joining us today for week 3 of BFSG's 2022 summer webinar series. Today, discussing behavioral finance and how to avoid letting your emotions kind of get in the way of long-term investing goals. Again, my name is Chad Noorani. I'm typically the host and facilitator. Today, actually one of the presenters. I am a retirement plan consultant here at BFSG, working with many of our institutional retirement plan committees on how to structure their retirement plans for their employees. And I got another colleague. I'm sure most of you are familiar with Paul Horn. Paul, you want to introduce yourself?
Absolutely. Thanks for having me again here, Chad. My name is Paul Horn. I'm the senior senior financial planner for BFSG Wealth Management. Apparently, I already need that second cup of coffee, so here we go.
Thanks, Paul. With that, let's kick this thing off, Mr. Horn. So, I think if you move on to the next page, just getting into a big question for everybody, right? How many of you consider yourselves above average investors? Now, we're going to do a poll on a very similar question on the next page, but this is not actually meant to be a poll. I just want to give some statistics looking back over the last 20 years or so. So kind of setting the landscape for why this is such an important topic to think through, especially think in 2022, we're already off to the worst 6 months in the stock and bond market in about the last 40 years. So very volatile to start this year. So if you think about what's on the page right now, on the left-hand side, right, the green bar shows the S&P 500's average annualized return over the last 20 years. Now, this starts at the beginning of 2002, so right after the tech bubble collapse. This incorporates the global financial crisis in 2008 and 2009, and the first half, if not more than half, of the COVID-19 pandemic. Right now, if you think about that, that means there were some years the markets were up really handily. Other years, like the global financial crisis, where markets were down around 40 to 50% in just 15 months. But had you started at the beginning of 2002, stayed invested for the entire 20-year period, your performance in just the S&P 500 would have been 9.5%. I want to focus everybody in towards the right-hand side, that bright orange box. The average investor in mutual funds in that exact same time period was just 3.6%. Now, the biggest question most people ask, well, how is that even possible, right? So just think back to, I think, recency bias, which we'll get into in a little bit, is think back to the global financial crisis, right? If you had in 2007, when the crisis started, $100,000 at the market's high in 2007, before it started to fall, by the end of 2008, your portfolio might have been down 30% if it was 100% stocks, right? And that's a hard thing. And for a lot of people, they cashed out at that point in time. The hard thing, though, is that 3 months later, in March of 2009, at the market low, most people thought they were right to cash out. Markets were now down 50% from their highs, but they recovered quickly. Only 3 months further, in June 2009, markets were back to only being down 30%. Now, most people didn't reinvest, right? They cashed out, thought they were right. Markets were really choppy, really volatile. The world's coming to an end. The government's pumping a ton of stimulus into the marketplace, still didn't get invested. Over the next 10 plus years, we went on the longest bull market in the last 120 years within the United States stock markets, right? So today, as of June 30th, that original $100,000 portfolio, including the financial crisis, the beginning of the COVID-19 pandemic, the subsequent boom during the pandemic, and even the worst start in the first 6 months in the last 40 years that we've seen in 2022, that original $100,000 portfolio today would be worth over $266,000 if you had done nothing. But I think we all know people, some of my own family included actually, that did cash out. And it's really hard when you try to time the market. You cash out, you got to be right twice. Once when to get out, once when to get back in. Unfortunately, many people captured that 30% loss and then reinvested when markets were back up above where they originally cashed out. And that's what leads to this 3.6% average investor, right? Had they just stayed the course, followed their financial plan, or even had a plan in the first place, maybe they would have stuck to their guns, stayed the course, and seen that better performance for their portfolio. So a lot of what we'll talk about today is kind of these discussion. What are the 6 things that kind of lead to that? So Paul, I know you got a fun thing for the group and a nice poll for everybody. Let's move on.
Absolutely. One thing I want to point out real quick is the average investor is invested in a portfolio that's 60% stocks, 40% bonds. So they should be getting 7.4%. However, the average investor is only getting about 3%, 3.6%, about half of what they should be getting. And the things we're going to talk about today are the leading causes for these lower returns for the average investor. So how many of you would consider yourselves to be above average drivers?
So with that, Go, Paul. Go, Paul. Go. I just lost
Okay.
the poll for everybody. So it is on your screen. Please let us know. Answer that question for us. We just want to gauge. We do have the real stat, but continue, Paul.
Yeah, so we'll take another 10 seconds here for everyone to respond to the poll. And then once we get that closed, we'll move forward.
I think we do have most responses in. Let me close that poll. And I will share results. Now, Paul, this is awesome. I think we have a really smart group, very humble group. We're actually pretty
Wow.
close to 50-50. 56% of you say above average, 44% say, yeah, maybe about average, if not a little below. But I think that's a really fair audience we have today. Now, let's see the real stat for nationwide polling.
Absolutely. This same question was asked to individuals across the nation. And what we saw was a very different response there. 93% of people polled said that they are above average drivers. So like Chad said, you guys are a very honest group, which is great to see. In this poll here, we only had 7 honest people that said that they were average or below average. Everyone else thought they were above average. And what's so interesting about this study is that it highlights our decision-making process and how oftentimes we are overconfident in our abilities. And this can lead to investment and other errors when we're making decisions. So when we talk about making decisions, how do we do so? Well, when we look at our brain, there's really 2 different sources that we are involved in the decision-making process in our brain. The most common, the one that does 80 to 90%, maybe more of the decision-making process is our inner brain. This is also known as the limbic system. This is the part of the brain that leads to that fight or flight response. So this is great when you're hungry and looking for a food source or avoiding walking off a cliff. And realistically, this is great for how much information we have to take in a day. Just think of on social media, how much information you're getting bombarded with on a daily basis, whether you're using Twitter or Facebook or whatever the case is, all that information is coming at you. And we need to process that information quickly. We don't have time to sit around and think about every little news article that we read. And so using this inner brain, which is powered by intuition or instinct, if you want to call that, and emotion, is used to fuel 90% of those decisions. And that's great for most of life. But when it comes to investing, we don't want to use this inner brain. We want to use the outer brain. The outer brain is your prefrontal cortex. And this is the one that's involved with logic and reasoning. This is the part of the brain that separates us from every other animal species out there, is our ability to do this. So when we're making investment decisions, most of the time people make emotional-based decisions using the inner brain, but realistically, we want to use that outer brain using a more logical-based approach.
Thanks, Paul. So, I want to play a little game with everybody. And I know some of you might have seen this game. And, so I need to get through this game before I share the slides. So I know there was something in the Q&A box about sharing the slides. I will put the link in the chat box in just a second so you can all pull it up. But real quickly, if you think about a baseball and a baseball bat, together total $1.10. Just thinking about this brain. And I'm going to ask all of you to come to a relatively quick decision, just a matter of seconds. If together they equal $1.10, and the baseball bat cost exactly $1 more than the ball, how much does the ball cost? I want all of you to come to that answer in your head, no poll, otherwise we'd give away our answer. Now, what most people say when they get to this slide is 10 cents, right? And it makes sense, right? Initially say, most people here, the bat costs $1, ball costs 10 cents, done. Well, Paul, click again. The actual answer, when you really stop and think a little bit slower about it, makes a ton of sense. I actually said the baseball bat cost exactly $1 more than the ball, which means the ball cost 5 cents, the baseball bat cost $1.05. So I think for a lot of you, if you've never read Danny Kahneman's Thinking Fast and Slow, is a remarkably good resource. I'll post that name in the chat box in a couple moments as well. Just some other resources that when we get off today's webinar that you can look to, books, audiobooks, et cetera, to kind of read it, dive even deeper into this concept of, it makes so much sense, 10 cents when you first hear it. And once you hear the actual answer, it makes so much sense why it's only 5 cents, right? But our intuition, as often as it's right, is often wrong when you get to these really, really simplistic, kind of concepts. So getting to today's agenda, Paul, what are we going to talk about?
All right, so these are the 6 most common mental errors, what I call mental accounting errors that people make that lead to lower returns in the market. So the first one is anchoring bias, confirmation bias, recency bias, herding bias, a lot of biases there, ambiguity aversion, and myopic loss aversion.
So when we get into this, kind of thinking about, Paul and I are going to go back and forth during today's discussion, talking about those 6 biases. So the first one I want to address is anchoring bias, right? And so just think, I'll give a very simplistic example, and then I'll give actual, money and investing example as well. But you think about a handbag, for instance, and even pricing it at $199 is a mental thing that retailers do because it means it's not $200. But maybe at $199, we still say, you know what, that's an expensive handbag. I don't want to buy it. But what if, Paul, and you click, if they were to say the retail price is $500 and we're going to discount it by 60%? For a lot of us, we anchor to that $500 and say, oh, the original cost is $500. $199 is a great deal for that handbag, right? And same thing goes for shoes, for suits, for clothes, for almost anything that we look to buy. Retailers, grocery stores, all of them use this technique to make it look like some of their goods and services are on sale, when in reality, they just price them a little bit higher to make it look like it's on sale, right? Genius. Now, when you think about the investing world, right? And I'm going to use recency, which I'm going to talk about in just a couple slides as well. And I'm going to use cryptocurrencies. And I hope that doesn't spark a ton of cryptocurrency questions. I think crypto and digital assets can be an entire webinar by itself. But just if you think about the phenomenon of Bitcoin, right? And around 10 years ago, it was around $100. And a lot of people thought it was expensive, right? It was a new technology. Nobody knew it. Nobody knew what it was or how it worked. Then in a massive run up, it ran up to around $10,000. And everybody really thought it was expensive, right? Like, what is this security? $10,000, that's crazy. Then it was at $20,000. And then it really seemed expensive. Then it actually fell all the way back to $10,000. And a lot of people said, oh, well, maybe Bitcoin's cheap. But if you forget, it was not even like 6 years prior to that it was expensive at $100. Then it went on a massive run up all the way to nearly $70,000. Now, was that expensive? If you think about it today, after falling more than 50%, Bitcoin sits closer to $20,000. So is it cheap today? Was it cheap at $70,000? Was it cheap at $100? Like, what is the reality for these types of assets, right? I think it's just a perfect example of people kind of thinking to, anchoring over their original hypothesis and kind of sticking to it. Now, think about Bitcoin. I think another thing for long-term performance before we move on is a lot of people, hindsight's 2020. And they see it at $70,000 and say, if only I had invested in Bitcoin, right? Even at $10,000, I could have rode it all the way to almost 70. I would have sold out before it came crashing down. The reality is, again, hindsight's 2020. And most people, when it went to 20,000 and came back to 10,000, even if they bought in at 10,000, the next time it hit 20,000, would you really have held it until it continued up? Or would you have said, I doubled my money. Last time it hit 20,000, it crumbled all the way down to 10. Let me get out and preserve my profits. And that's actually what most people do from an investing perspective, like behavioral finance perspective. And then it runs up to 30 or 40 or 50,000. And some of them even get back in at higher prices than they originally sold, risking all those profits because it's FOMO, fear of missing out. So when you think about investing, always remember hindsight's 2020. What would you have actually done if you held that security during its remarkable run up?
All right, next we're going to move on to confirmation bias. Confirmation bias is a natural tendency of us as humans to want to interact with things that or people that are like us. And we want to take in information that supports our beliefs. Most people don't want to be wrong or are comfortable processing information to be wrong. Think about just like social media right now, whether you're using Facebook, Twitter, Instagram, whatever the case is. You may go on your Facebook feed and you may like a post from a conservative person because maybe you're conservative, or maybe vice versa. Maybe you're liberal and you like a post from someone else that's liberal. Well, now what happens is those algorithms take that information and they're going to keep feeding more of those posts like you. And so what ends up happening is it leads to this innate thing on social media where everybody kind of gets into these silos where it's just everybody agrees with you. So people on social media typically only interact with people that have similar or like-minded views as they do. And this is a real world problem because when we're taking in information, making investment decisions, we need to see both sides of the coin. But confirmation bias only allows us to see one side of that coin. If I think a recession is coming and I'm watching the news, I'm only going to get the bits and pieces from the news. I'm only going to remember those that confirm my idea that recession's coming. If I believe that recession is not coming, I'm going to see all the information that says the markets are strong, things are getting good. Maybe I'm going to miss all the things, all the early signs that maybe recession is coming. So when we're making investment decisions, we need to see both sides of the coin. We need to be willing to be uncomfortable and hear information that says we might be wrong, and that's okay, so that we can make a better investment decision long term. I love this quote by Muhammad Ali. I think it really sums up how most people use social media these days. I don't always know what I'm talking about, but I know that I'm right.
Yeah, I love that quote too, actually. So next we're going to tackle recency bias. And I just talked about this, right? Like, it's why I did a Bitcoin example. It's so just fresh in my head because these things are so new. So basically the gist of recency bias, because I'm not just going to read what's on the slide, that's there for you to read. You have the slide deck, is that things that have happened recently in our life stand out the most, and stand out much more than things that happened, a decade or 2 decades ago, right? So that I'm going to give 2 examples here, right? So if you think about, first, just think about movies in general. If I were to ask you to recall 20 movies off the top of your head, you're most likely to recall movies that you've seen in the last 1 to 2 years. Now, you might have some all-time favorites and movie classics, like from way back in the day, that come to top of mind because you watched them so many times or so frequently. But the bulk of movies you will recall are things you've seen very recently, instead of pulling up movies you saw 10 or 15 or even 20 years ago. Right now, think about that in the investing world, right? This concept of noise, quote unquote, is remarkably prevalent, right? The media is here pushing out just news story after news story after news story, and that changes over time, right? Today, right, it might be Russia and Ukraine, right? It's Nancy Pelosi is going to show up in Taiwan as today's news story, right? But just a couple of years ago, it was Donald Trump was elected president. He's going to build a wall, right? Tariffs on China, right? China, TikTok was a big story. Think back, decades ago, we had presidents assassinated. We had a Watergate scandal. Like, there's always the new noise of the day that's kind of sparking some of our investing decisions. So one of the things I love to do just in my own personal life and investing is as much as I think I do probably the best research in the morning, right? 6 a.m., fresh, I have my cup of coffee, I'm bright-eyed, bushy-tailed, ready to go. But the reality is, though, that's right when markets on the East Coast are opening for me, and I live in California. When I tend to do the best investment research is 6 p.m., right? As much as it's the end of the day and I'm tired, I'm objective, and I cannot actually act on any decision I make until tomorrow morning. So basically, I'll kind of write down all my hypotheses. I'll write down all my ideas, all my thoughts. And in the morning, when I'm at my mental peak, is when I'll actually reevaluate all those. Now I've slept on them for at least 8 hours, and I know that I'm making sound, rational decisions based on research I did when there was no brand new news that can kind of drive my investing decision-making process.
All right, the next one we're going to talk about here is herding bias. Herding bias is the tendency of one individual to follow a larger group. Most of us individuals like to think that we're individuals, that we're different, that we are contrarian and against the grain. I know for me, I loved punk music in high school because it was fight the system and go against the grain, right? And then as I get older, I just realized I was following the herd because all my friends and everybody else I knew in high school was listening to the exact same punk music. Rage Against the Machine, another example. The name says it all, Rage. That's one example that I've used here for music. I'm going to show a video here in a second, and I think it's going to explain this herding bias in a much greater way. What we're going to see here is a social experiment that was done where you're going to have a bunch of people that walk into an elevator, and like crazy people, instead of facing the front of the elevator, they have their backs turned and they face the back of the elevator. Now, if I was walking to the elevator, I would like to think that I would be freaked out and be like, what's wrong with these people, and not get on the elevator. But on this video, we're going to see what happens when we have a whole group of people facing the back of an elevator. And what does one person do when this is not normal social behavior?
So you walk into an elevator and naturally you turn and face the door, right? It's just what we do without even thinking. All right. In the blue t-shirt, that is Nadia. She is an innocent passerby. Has nothing to do with this. Everybody else in that elevator, they all work for Would You Fall For That. They are all in on the experiment. They are all purposefully facing the wrong way. Nadia is facing the front. You can just see the back of her head, wearing the blue t-shirt. That's Nadia. She is facing the front of the elevator like a normal human being. Everybody else is facing the back.
That's true.
We're playing this to you in real time, no editing, as it actually happened. Okay, floor 2. Rebecca gets off, Emily gets on, she also works for us. We're swapping people in and out to reinforce the behavior. Emily's acting like it's the most normal. Oh, Nadia's turned. Nadia, okay, her bag is slipping off her shoulder. She's nervously playing with it.
Yeah.
Nadia's now halfway round. Will she go any further? Emily gets off, Mike gets on. Again, Mike works for the show. Presses his button, faces the back like it's the most normal thing in the world, like he does it every day. Nadia is really feeling the pressure right now.
I'm not going to see anyone else.
Isn't he on
Scott's making some small talk.
He was in celebrity rehab, I think.
Oh.
Yeah.
She's looking towards the back of the elevator because everybody else is. Floor 4.
I love the guy.
4th floor, Mike gets off. Lauren gets on. Lauren also works for us. She's in. Oh, and Nadia has gone. The 4th floor, Nadia has turned all the way around. She's looking at the back of the elevator. That is not normal human behavior. Nadia is looking at the back of the elevator purely because everybody else is. Okay, you've seen it in real time. Let's play that for you again.
End of the day, that old premise of peer pressure is a real thing.
Yeah, I love that video, Paul. 2 minutes. We've never tried that one before, doing a video on one of these things. So like it's such a fantastic and fascinating thing to watch that actually take place. So the next one, moving on, is ambiguity aversion. And so, what is this, right? And just to focus on the 2 briefcases, right? First one is number 1. Imagine if you were said, I need you to pull out a red ball, right? And your bag 1 has 50 red balls, 50 black balls. The probability of success is 50%. Right? The other side of that, what if I say, here's bag 2, I need you to pull out a red ball. There's 100 balls, it's a mix of red and black. That's it. Right now, most people in this example almost always choose bag 1. And the reason is because it's guaranteed to be 50% probability. And you just don't know, right? Bag 2, it might be 75 red balls, it might be 25 red balls. Since you don't know, most people choose not to go with bag 2. They just go with bag 1 all the time, right? So, and you can see this across the board, right? Across investing, you tend to invest in companies and not invest in companies you don't know, which is great, right? If you're going to invest, you should really dive into the companies, understand everything about them. You should know them arguably as good as the back of your hand before you're willing to become a shareholder in them. But a lot of people that just don't do research pick names because they're common, because that's what their friends are talking about, because that's what they talk about. If you love technology, you tend to be heavier invested in technology. If you love cars, maybe you're invested in the automakers, right? You just invest in things without really diving into building a diversified portfolio and thinking through some of those things.
All right, and the last one here, which I think has the funniest name, myopic loss aversion. That's big fancy words to say people don't like to lose money. Okay, lots and lots of studies have been looking at behavioral finance and how emotions are involved in the decision-making process with investing. And what we've learned from those studies is that fear or pain is 2 times a stronger motivator than greed or pleasure. Let me say it another way. If you have the ability to lose $100, the emotions you feel are going to be twice as strong as the emotions you would gain from receiving $100. Okay. So what do we know? We know that fear is the biggest motivator. And this is something to be very aware of to avoid a lot of those decisions that impact your investments, because so often people make short-term decisions based on emotion that have real-world impact on their long-term returns. This is probably, in my opinion, the biggest thing that's leading to retail investors getting 3.6% instead of the 7% return investing that they should be receiving.
So with that, we're going to do our second and last poll of the day, right? And so in this poll, you have kind of 2 options, right? Choice A is a probability of 80% of making or losing $4,000. Choice B is the 100% guarantee of making or losing $3,000. So let me launch this poll. It is a two-part poll. So you're actually going to answer both questions. On the first side, if you were going to make money, would you choose option A or B? And the second question that should have just popped up is, if you were going to lose money, would you choose options A or B? Please let us know your thoughts. We'll let this poll run for just a few more moments, and then we'll kind of talk about what most people tend to do when they're kind of given this exact same option in the real world. I think with most responses in, let me end the poll. I will share results with the group kind of while I talk through it, right? So the idea here, and this group, right, this audience actually falls exactly in line with what most people in the world do, right? This idea that, when it's to make money, people want to guarantee they're going to make $3,000, right? An 80% chance to make $4,000, even though it's a third more money, is gambling, right? And they'd say, I'd rather guarantee $3,000 than potentially only make 1,000 or 2,000. Why would I do that, right? But on the way down, if they were going to lose money, most people would rather gamble and potentially lose up to $4,000 for the chance to lose less than $3,000, right? The statistics behind this, if you pull up all the complicated math and stats, is that the choices should actually be identical between both of these, right? That the probability is equal to get to that $3,000 mark. But at the end of the day, what this is showing is that loss aversion is a real thing, right? People are willing to gamble with losses, but not with gains, right? And it gets back to that example I used with Bitcoin, right? If you bought it after it had been at 20,000, fell to 10, and you bought it at 10, when it went back to 20, would you really have held it all the way to $70,000 like hindsight tells us we should have? Or would you have sold it at 20, expecting another collapse back down to $10,000 and just looking to gain those profits, right? It's a hard thing to do to keep all those profits at risk, but it's awesome to see that this group, this attendee list, is exactly in line with the broader national audience. So if we continue that on, and this gets back to, how often should you really be reviewing your portfolio, right? Especially in periods of really heightened volatility like we're seeing in 2022. And so if you think the left-hand side is for people that tend to review their portfolios on an annual basis, right? Once per year, and say they're an investor that should have 70% stocks, 30% bonds. Again, this is a hypothetical example. For some of you, you might actually, maybe your Horizon or financial plan says 90% stocks, others maybe 50% stocks. So again, this isn't saying you should have 70%, but a hypothetical example of somebody that should have a 70% stock portfolio, and they review it every year, they tend to stick to that. That same exact investor that it reviews their portfolio every single month, as much as it says we probably should do that, right? Like, you want to be in tune with your finances. You want to know what's happening in your portfolio. I know people that look at their portfolio every single day, actually. That same investor typically has less than 60% stocks in their portfolio, just because everything going on in the news and the noise in their portfolio, and this being too risk averse, right? Just thinking through, well, you know what? I think that might impact the markets, or that might impact my portfolio. Let's sell a little bit of my winners and cash out today rather than staying invested for the long term. Even though their financial plan might say they could withstand a 20% drawdown in their portfolio and still have a 99% probability of success. So it's going to be counterintuitive, Paul. Just can you put that funny slide that I put in here on the next slide? Every now and then, as much as you never want to do it with your investing portfolio, and we always coach and say you should really be in tune with your money and finances, sometimes it might make more sense to act like an ostrich with the head in its sand, especially in these periods of really heightened volatility, and let your portfolio write out your financial plan.
So you're saying ignorance can be bliss?
Ignorance can be bliss in some cases.
All right. So we've talked about what we believe are the 6 biases that impact investors' behaviors the most. How do we break those behaviors? Well, number one, you need to get to know yourself. You need to have an honest self-assessment. Looking at that first poll question, where about half of you said you're above average and half of you said you were probably average or below drivers, that tells me we have an honest group. And so that's great. And you've got a head start on the average individual. But you really need to look at yourself and understand what biases are impacting your financial decisions. Someone may be more impacted by recency bias. Another one may be impacted more by confirmation bias. So understanding these and how they impact you is really important. Secondly, avoid panic selling. And Chad, I think, had a great example here where He talked about not placing any sell orders during market hours, but instead he chooses to sleep on it. That takes out that emotional kind of gut reaction, that inner brain of like, got to do this, can't lose more money, can't lose more money. And instead it moves it to the outer brain where you're able to think logically and rationally and make hopefully a more informed decision. You need to stay focused. All right. Don't dwell on the past. Don't worry about, oh, if I were, like Chad said, hindsight's 2020, right? Don't focus on what could have been. Focus on what could or should be and maintain that long-term perspective. And finally, consult with your financial professional on a regular basis. All right. A financial professional, they're great to work with. And the primary reason for that is not because they're smarter than you. It's not because they can pick great stocks. It's not because they're a great talker or good looking. It's because it's an independent third party that can help you take the emotions out of investing. Let's be honest. When we're talking about investments, this is literally your life savings. It is impossible to separate your money from your emotions. It just doesn't work. But having someone that's an independent third party can help you avoid from making emotional based decisions that have real world impact on your life savings. So what are the fundamentals for investment success? Like anything in life, it starts with having a plan. Studies have been done. If you write down a goal, you're 80% more likely to accomplish that goal just because you wrote it down. The same is true for your finances. Writing it down for your finances should be a financial plan based on your individual goals. Start saving and investing today. Whether that's $1, $10, $100, $10,000, doesn't matter. We all start somewhere. So why not start now and just make small incremental increases to that over time? Build a diversified portfolio based on your tolerance for risk. And this is really important, that tolerance for risk part. Because when we look at investing, you can think of a scale of 1 to 10, right? 1 being let's put all the money under the mattress, 10 being let's go to Vegas and put it all on black. All right. I have some clients that are 90 years old that are happy to go to Vegas and put it all on black. I have other clients that are 20 somethings, watch their parents struggle through the Great Recession. And as a result, they're very conservative and can't sleep at night if they lose a dime. So have a good idea where you fall on this spectrum and invest your money accordingly to that. We want to control things that we can control and let go of things that we can't control. What we do control is fees and taxes. We know if we keep the taxes lower and the fees low, that gives us the best potential for long-term growth. We can't control things like what the market's going to do tomorrow, how the stocks are going to perform, are the companies going to hit their earnings numbers or not? We have no control over that. But if we focus on what we can control, it's greater peace of mind. Build in protection against catastrophic losses. This could be having a rainy day fund, like an emergency fund. It could be having disability insurance. So if something happens, you don't have to sell your investments. You know that you're going to get a paycheck while you're out of work for a few months, whatever the case is there. We just talked about this, rebalance your portfolio on a regular basis. And number 7, we also just talked about ignore the noise. At the end of the day, I like to joke around with my clients and say, look, you do your thing. Let me worry about the stock market on a daily basis because this is what happens. So let me lose my hair and you can keep yours. This is the team of financial planners here. BFSG, we have Keith, Mike, Paul, Tina, Mark, Arash, and Justin. Great team to work with you guys on a regular basis. And we're actually missing another guy, Henry. His name should be up here as well. Recent new hire who is a great financial planner.
Yeah, so as we wrap up today, again, our contact information for anybody that does have follow-up questions is up on the screen. At this time, we actually only have one. So I don't know if we just wowed on Paul or what, but let me get to that question and we'll see if anything else comes in while we are addressing it. First question is your thoughts on active versus passive investing and how that might fit in with behavioral finance.
This is a great question. So passive investing, the nice thing about it is it maintains that disciplined approach because you tend to be more hands off. So With a passive investment, you're just trying to mirror what the market does. You're not trying to beat it. And so passive investors tend to have pretty good returns over the long term. And it's not because the investment strategy is better than active. Active sometimes is better, passive sometimes is better. I'm not saying one is greater than the other. But the nice thing about passive is it helps remove the emotions out of the investment process. And so, that's the one part I like about it. Chad, what would you add in there?
Yeah, I mean, I agree with most of what you said, actually. I think, we tend to be agnostic. And, I think active investing is smart for some people, passive is smart for other people. There's a lot of research that says active managers, don't outperform their respective indices. There's also a lot of research to the contrary, that if you can pick the right active managers, they do tend to outperform. And a lot of that comes in, some active managers are trying to beat the markets. Some are trying to protect your assets on the downside, right? If you think about a $10,000 portfolio that loses 50% one year, it's down to 5,000. And if it makes $50,000 or 50% the next year, it's only back up to 7,500, right? On average, it made zero, but you actually still lost 25%, right? So this idea that a downward move in your portfolio is actually far more impactful to your long-term investing than upward moves. There's a lot of active managers trying to protect your assets. So they might not keep up in up markets quite as well, but they do better on the downside. So those are some things to look at. I think another thing that people forget in most of these index investing is, in most big market cycles, tech bubble leading up to the financial crisis, and then most recently, the most recent boom, indices, especially like the S&P 500, are market weighted indexes, and so they become relatively concentrated, right? In this most recent boom through the pandemic, more than 20% of that index was concentrated in only 5 stocks. And they're most commonly referred to as the FANG stocks, like the Facebook, Amazon, Alphabet, and Google, right? Netflix, et cetera. And what that means is that just buying the S&P 500 means you're putting over 20% of your assets in one or in 5 stocks, right? Which is a pretty concentrated position. So just understanding that, and when you have market pullbacks like today, where some of these growth names are pulling back, that's driving the S&P 500 index down pretty handily as well. So just things to be aware about. I think index investing is a remarkably efficient way to invest. I think for younger investors, you should be really fee conscious. It definitely makes sense. But as you get closer to retirement, there's other strategies that might make sense. Things like municipal securities and taxable accounts and things that working with an advisor and a financial planner might make sense for your individual situation. The next question, I think one is actually a comment. I think one of our listeners wants us to give another book recommendation. I know I put 2 in the chat box already, Thinking Fast or Slow by Danny Kahneman, and then another one by James Montier, this little book of behavioral finance or investing. This one is Nudge, which is about, I haven't actually read it myself yet, but how people are being nudged to make the right decisions in their portfolios.
So I know with what we're doing here, I have a lot of education behind my credentials. So I'm a CFP, a master's in investment management, a CPW, certified private wealth advisor. All those are fine for what I do. The most important designation that I have is my undergrad in clinical psychology. Because at the end of the day, we're in the people business and helping individuals. And as we've talked about, people aren't rational. We have emotions, we act on those emotions. Okay, that's just the reality. And so what we try and do is provide a lot of education, and we try and keep things very high level and very simple in a way that people understand to help them not make any emotional decisions. So I guess I'd say through education and that human approach is how we are kind of nudging people into making the right investment decisions.
Thanks, Paul. The next one we have here is this is 2 parts. I'll help you answer this too, actually. Is having a financial planner any more reliable than using an auto investment account? That's a really good question.
It's great. And I think those are, at the end of the day, if we want to avoid making these mental accounting errors or these emotional based investment decisions, is another way of saying that. The best thing that we can do is automate things as much as possible and have a very disciplined approach. If we have a disciplined approach, we're less likely to make those knee-jerk reactions and maybe place a sell order when we shouldn't, or whatever the case is. So having an auto investment program where you're just putting money into an account each month, that's a good way to invest, especially right now. A lot of people, starting to invest and they're just kind of freaking out. Markets are down. They don't necessarily want to get in when the markets go down another 10, 20%, But if you just put in the same, $100 or $1,000 every month in an automatic investment plan, doesn't matter what the markets are doing, you're getting more and more exposure and you're buying more shares each month. And so that's a very good way to kind of help take the emotions out of it. I think having a financial planner is that second layer. I think that first layer is having that auto investment program, but that second layer, having that financial planner there, someone that can put a plan, again, put it on paper, gives you an 80% chance of reaching that goal. If you don't write it down, probably not going to get it accomplished. So having that financial plan increases the odds that you're going to reach your goals in the time that you want to reach them. And secondly, it gives you that independent third party just to help remove the chance or reduce the chance that you make those emotional based decisions or help avoid making those mental accounting errors that we talked about.
Yeah, I love that answer. Let me reiterate that a little bit. I would keep those two things separate, right? A financial planner is not the person investing your account for most cases, especially at most wealth management shops and advisory shops. Even here at BFSG, Paul's a financial planner, and there's a different group of people in here for people that give us money to manage. So some people just have him do a financial plan for them to help, keep them on track. Most do have us manage their money too, but it's a very different thing, right? Paul's there to help you plan for the rest of your life. Every financial, Paul, how many of your clients come to you for almost every decision? Like, I want to buy a house, I want to buy a car, and they want to ping you and see how it impacts their financial plan first.
Oh gosh, 75, 80%. I mean, honestly, my wife jokes around with me and calls me a glorified hairdresser because it's more working with people and hearing their problems and helping them. There's a lot of kind of life coaching sort of skills that are involved in what we do as well.
Right. And so I think it's this idea of the planners there to help you stick to your plan, not necessarily manage your portfolio, right? So managing portfolio is a separate bucket. I think one of the big things that Paul and team have been doing with some of their clients, though, is you have a financial plan and you have the investment portfolio geared towards your risk tolerance. And markets have been volatile this year. So obviously clients are calling, they have questions, they're concerned, and doing like a 5-minute check-in. Markets are down 20%. How does that impact my financial plan? And I think what most clients are figuring out is it actually doesn't have a really big impact because they're still projecting for markets to recover at some point. And most people are still actually on track for their successful financial plan down the road. So it's more so having that person to call to talk you off the edge, talk you off the cliff, and kind of help you stick to that financial plan for the next 10, 20, 30 years in through retirement. Next question. So we do have a couple more keep coming in. So that's awesome. Please keep typing them in here. So next question is, can you realistically plan on an actual 1 to 3% return on your investments? Let me touch with that first, Paul. I think you'll have some good things to add. I would start with how much risk you're willing to take in your portfolio before thinking about the return. I'd say, most experts, depending who you talk to, from all the biggest banks and investment platforms out there, most people are saying you're probably looking at long-term, next 10, 20 years, realistic performance in the stock market of somewhere between 4 to 6%, right? There's none of these like high 9, 10% expectations like they used to have 20 years ago. People have definitely dampened those expectations down to that 4 to 6% range. But again, that is a 100% stock portfolio that most people are thinking about right there. And for most people, they should have some component of fixed income or bonds in their portfolio, even some level of cash in their portfolio for liquidity purposes. That maybe that does come down from 4 to 6 to 3 to 5% or 2 to 4%. I think it really goes back to how much risk how much are you willing to lose in your portfolio? I think this is another thing. It gets into women versus men and how they look at risk. I was just at another conference talking about how women perceive risk, and one of the things that one of these advisors talked about is when you talk to men, they tend to say, okay, well, I'm willing to lose this much of my portfolio. But one of the women came up and said, you know what, when I hear risk, I don't think about how much I'm willing to lose. I think about, am I willing to jump out of a moving car? That's what risk meant to them, right? It's a completely different dynamic. So really think about your portfolio, think about how much would you be willing to lose in any given year and how that would impact your long-term financial plan. And then work with your financial professional to figure out how much return could you expect to receive from that? And how much do you need to have a successful financial plan? Paul, anything to add there?
No, I would just say, having a financial plan helps you kind of identify what you should be targeting in terms of allocation.
The last question we have here is your thoughts on things like fractional shares, right? Like Robinhood and some of these other platforms like Stash have launched the ability to buy pieces of shares instead of whole shares. Do you have any thoughts on these?
So it's an interesting concept. In the past, you really needed, I'd say 500,000 at minimum, 750 $750,000 to $1 million to really begin to invest in individual stocks. Because it takes about that amount of money to be able to build a diversified stock portfolio, right? When we do investing, we always want to be well diversified. So the cool thing about the fractional shares is now when you buy you don't have to buy a full stock share, because a stock share may cost, $1,000, but maybe you can own a tenth of that stock. So maybe you put in $100 and then you own 10% of that stock or 1/10 of that stock. So that's the idea of fractional shares. It's a way for the average investor to begin to be able to have individual stock exposure if they choose to. I think it's great in concept. At the end of the day, I still like the idea of using an ETF or a mutual fund, at least in the beginning, because I think that's going to give you a little bit more better diversification. If you ever decide to move from Robinhood or Stash or some of those places to maybe another account that doesn't offer fractional shares, it just avoids some complexities there.
Yeah, I agree with almost everything that Paul just said. I think the one thing that I'd add, and where it could be a positive, and it really does go back to how much are you willing to start with investing, is I think for a lot of parents, it creates this opportunity to educate their children on saving and investing. I think back to when I was with my younger sister is many years younger than me. My parents decided to restart, I think like 15 years later. And one of the first things we did for her, relatively young, I think she was like 5 years old, is we bought her a share of Disney stock. She loved Disney movies, loved Disneyland, all this stuff. We bought her a share of Disney stock, set up a brokerage account for her, and she started paying attention to it. And basically from that point on, anytime she got cash for Christmas or birthdays or any of these events, she started asking my mom to buy more Disney stock with her because she was watching it. And luckily for us, Disney stock was moving up at the time. And she started buying Disney stock with all of those future proceeds. And I remember, her first grade teacher, my parents came home from like a back to school event, and I was back visiting from college. And they go, the first grade teacher said, "It's so fun coming to school every day because I get the updates on the stock market from Haley." And it was so just cool to think about this, like a 6-year-old educating their first grade teacher on what's going on in the economy and stock market because she was so interested in paying attention to it. Lo and behold, she ended up going through getting a finance degree, but data analytics. She's actually working for Disney. Fun story and fun fact. But it's just a really easy way. Fractional shares is a way to start building that investing knowledge and saving knowledge really early, when you might not be able to afford a $1,000 share or a $100 share starting really young. Paul, so we got a few more questions that have come in here. Let's see. The next one I have, I read that in many cases, the financial advisors or money managers themselves are not invested or following a financial plan as they advise. Would you say this is the case for most of the advisor industry?
Not the advisors that I've worked with or the places I've worked. Certainly there are some people that don't take their own medicine that they're selling. Maybe not the best place to be if they're not willing to put their own skin in the game. But most advisors that I know that I work with, or friends with, or have worked with, they've always been putting their own skin in the game, right? They're investing their money the same way they're investing their clients' money. So for most advisors, I think that's the case.
Yeah, I'd say it is actually one of the things we look at when even on the institutional side where I am, not working with individual clients, but companies and universities and cities in helping build their 401k plans for their employees, is how much do the money managers have invested? Like, we do look at that. We want the money managers to have skin in the game, because if they're not invested, can they truly have all of the mutual fund investors' best interest at heart, right? They should believe in their strategy. They should believe in what they're buying. So that is definitely one of the qualitative factors that we evaluate on the institutional team at BFSG too. So yeah, really, really good question there. I think the other side that is worth thinking about is, are they a commission-based advisor or a feed-only advisor, right? So there's still two different paradigms in how advisors work with their clients. So if you're familiar with us at BFSG, we are fee-only. We do not make commissions. We don't sell insurance or annuities or any products, all with this effort to be as conflict-free as possible, right? If Paul's team tells you to buy insurance, you should probably buy insurance, because he's not going to sell that insurance policy to you. He's going to suggest you go talk to whoever does your home insurance, your auto insurance, and do you already have a broker? And this is the insurance policy to buy, right? So there's no conflict of interest there, because he's not going to make a commission off that. Other advisors still do have a broker dealer behind them, and what that means is when they buy a share of stock or they buy a mutual fund, they might get paid a commission on that transaction, right? And so at the end of the day, I think it's important to understand how the advisor you're working with, like, what is that relationship? How are they compensated for their services to you and what they're doing within that financial planning and investment management program? Did I miss anything there, Paul?
No, I think that's really good.
So then the last thing we have, it's not really a question again, but is I think another one of our attendees that put in the Q&A box, just I think just a shout out for the conversation on fractional shares, right? The Robinhood, Stash, SoFis of the world, these platforms that allow it. I think we do have an attendee that says, you know what? At the end of the day, it was a great way to get in and build up to one share, right? I think a lot of these big tech companies recently did stock splits, so their stocks are only $100 or $200, but a matter of a year ago, right? You have Amazon that was $2,000 and Google $2,000, and if you could get in and put only $200 in and buy a piece, and every month you buy another piece, eventually you have one full share of that company. And so I think that's what this attendee is telling us is, for those of you just looking to start, just looking to get invested, start paying attention, is fractional shares is a great way. Once you own a piece of a stock, you will definitely pay more attention to it. The best way to educate is to pay attention. So I definitely encourage all of you, do whatever it takes to get started, get invested, and start paying a lot of attention. With that, Paul, before we close, any closing remarks? Again, that was the last question we had today.
No, thanks everyone for attending, and please don't hesitate to reach out if you have any questions on what we heard today.
Yeah, thank you so much, everybody. We definitely appreciate your time. I hope everybody enjoyed today's presentation. And please do complete that survey. Let us know your thoughts. And we look forward to seeing you all next week. Thanks, everyone.